Sorry, I'm just going to go back here. This is the morning market review. Welcome. My name is Russell Shulman, Senior Market Specialist at FXCM. My email address r@fxcm.com. Today is Thursday and it is the 19th of Jan. Let's just go ahead and bring up the high risk investment warning. And hey, okay, cool. Can you guys see the screen? Can you see me on the camera? And can you hear me? The three checks. Okay, good. Excellent. Thanks, Jakim. Thanks. All right. Let's bring up the market commentaries disclaimer. And here's our references, Market Scope and Trading View. We're going to start off with Trading View. I want to show you this chart first. So here we've got the stagflationary period, 1970s. We started looking at this really as the stagflation issue became apparent. It's time to look at it again. And what you can see is that the black line is PPI, the red line is core CPI. Generally, in the first oil crisis, it was PPI that led CPI down. A little bit different in the second. The CPI turned slightly ahead of the PPI, and then they came down together. The big idea for me is actually to look at the position of PPI relative to CPI. In other words, when it crosses below over here and leads the CPI down, it never really got above CPI here. CPI was above PPI going back to the second oil crisis. It turns down and it leads CPI down. So we just looking at it similarly here, and we're getting pretty close to a crossover. Okay. I think the crossover might even be secondary here. This is very much, this situation is more like the first oil crisis than the second oil crisis, in that it is PPI that turned first and is effectively leading the core CPI down. Again, I think it's worth monitoring this just for some sort of crossover event. I don't think that it is all that important. I think the fact that these now are heading down together in tandem, very similar to the previous two oil crises. It seems to me that inflation is done, okay, barring any sort of upside surprise. We've looked at the mean CPI, the mean CPI is rolling over. Everything's sort of aligning at this stage. So again, it might be the case where we have some sort of surprise. The key here, I think, would be to carry on monitoring that median CPI. As long as that median CPI is rolling over, I think we're safe, subject to correction. But if that median CPI turns up again, then we'll be in trouble. So we'd monitor it from that point of view. But this, I think, is quite interesting. This is an important start to the conversation today, because I'm going to state my base case scenario now, and my base case scenario is that there has to be a Fed pivot. That's a base case. There could be a best case, there could be a worst case, right? So the base case can adjust, but my base case is that there will be a Fed pivot. And I would suggest also that the pivot, which is priced in the markets in June, may actually be forced before that. And these are big statements. Okay, that's why I'm going to go subject to correction. But I'm comfortable to put that as my base case, given the data that came through yesterday. And I want to just show you the what we have here is industrial production. So we've got industrial production for the US on the top chart. The bottom chart is retail sales. It's retail sales minus inflation. In other words, what I'm doing here is I am taking a look at retail sales and I'm adjusting it for inflation. In other words, okay, the number that we get, the number that we got yesterday is not adjusted for inflation. It came in on a year-over-year basis of 6%. When you adjust for inflation, we are showing contraction. We're contracting. There's a contraction. You can see we actually at minus 0.5. So retail sales are down on a real basis year over year. The industrial production is moving towards zero. Okay, I haven't actually adjusted this for inflation. So the idea here is you can see the red arrows. This is now obviously something that we can suggest gives a very heightened probability to a recession, the hard landing, soft versus hard landing. I think it's almost impossible now to say that we're not moving into recession unless we get some really different and more positive data. But this data is quite abysmal. There is a case to be made for the Fed pivot based on a recession type of scenario. Let me bring in Microsoft Paint here. Just bear with me. Okay, so we're gonna do a webinar on the 9th of Feb, our 2023 outlook. But if I show you the Fed funds futures, it's something like that. Okay, it's something like that, and we can say that the terminal rate here is in June, and then there is a case for cuts in the second, or not a case, there is a pricing in the markets for cuts in the second half. That makes 0 sense unless there's a recession. You're not going to get these cuts as aggressive as this unless there's a recession. So the recession, okay, is certainly looking increasingly likely, if not already here. So should we see the unemployment rate going up? Yes, but that's going to lag. The unemployment rate's a lagging indicator. Let's just take a look at, that's actually a really good comment. I just want to go back to the single. Yeah, unemployment is actually where the adjustment needs to take place for wages now. Let's just bring in U3. Okay, so unemployment. Let's just bring in unemployment. U3 is a very narrow measure of employment. It looks terrific. It looks at 3.5%. Okay, it looks at 3.5%. This should theoretically start ticking up if there is a recession. Microsoft, I think, announced, subject to correction, I think this sounds a little too high, but I seem to recall a number of 10,000 employees. Goldman Sachs 3,200, Amazon 18,000. These are all going to get severance packages, Anna. So severance packages means that they probably aren't going to claim unemployment until the severance packages are up. There's probably about 6 months lag there, right? But what we can take a look at is a few other things. So let's take a look at unemployment claims. All right, so I don't want to look at the initial, I want to look at the continued. Okay, so let's just, so initial would be first time claimants. Continuing is the amount that can't get off of the unemployment. Okay, so interestingly, it's hooked down. Okay, so we want to just give, it's coming out today. Unemployment claims coming out today. Okay, but you can see it's rising. Okay, it has broken a trend line. We'll keep an eye on this. Okay, but the continuing unemployment, the people that can't get off of unemployment, that's rising. Okay, the next thing that we can look at, let's just see if overtime is here. No, it's not yet. Okay. Average hours. Okay, United States average weekly hours. Okay, this is a really bad number. Okay, people are working less and less and less. Okay, so before people's jobs get cut, they get given less hours at work because it is hard to find capable employees. So when you've got them, you don't want to let them go. So you'll cut down the labor, their labor hours until it becomes impossible to keep them on. So the labor hours has been coming down dreadfully, and it's really sparked down. This last movement here, that sparked down. Okay, let's take a look at part-time. Underemployed. Am I spelling that right? Not picking it up. Let's try part-time. Okay, so you can see that the part-time is ticking up here. Part-time is ticking up here. Let's just take a look at full-time. Okay, so this is a story here. Okay, this is a big story. All right, full-time employment's coming down. Full-time employment's coming down. People can't find the full-time, so they are accepting part-time jobs. 100% of the job gains. I read this. Now, you can. I suggest you just take a look at it into it yourself. But 100% of the job gains of the last non-farm payrolls was part-time jobs. So what we can do, watch this. Full-time. Let's do it this way. Part-time. Okay, watch this very carefully. My spelling is, I haven't quite finished my morning coffee yet. That's probably why I'm spelling like a first grader. So let's take a United States part-time, okay? Now watch what we're gonna do here. Watch what we're gonna do here. We're gonna divide it. So we're doing a relative strength analysis. Watch this very carefully. We're gonna divide it by the full-time, okay? Okay, so we've got a relative strength now between part-time and full-time. Now this is not healthy. Okay, it's healthy for part-time to be falling relative. Okay, it's healthy for part-time to be falling relative to full-time employment's healthy, okay, but when full-time employment's falling and part-time employment's rising, especially when you're getting reduced average weekly hours, especially when your continuing claims are starting to climb, that's not a great sign, okay? And the unemployment rate lags, and there's going to be a lag because of severance pays, okay? So we're going to have to be very, very cognizant of that fact. So the adjustment is already starting to take place in the labor market. The labor market is not as strong as being reported. It's weaker than is being reported, which is aiding the base case scenario, subject to correction. Okay, now if there is a Fed pivot, this is a case of bad news is good news for the markets. As interest rates come down, markets are going to move up. Okay, let's just look at one more chart, and then we're going to start looking at potential trading opportunities. Okay, now let's take a look at this. Two more charts, and then we'll look at trading opportunities. US 10-year. I am certainly needing to finish that morning coffee. Sorry, not so the 10-year minus the break even to get our real rate. Okay, let's bring that up. Okay. And I wish I could answer that, but I would suggest that we are moving into a tougher. If we are not already in a recession, we're certainly heading, in my opinion, towards recession. Watch this very carefully, guys. This is the real rate. Okay. This chart, one other, then we're going to get to the actual instruments. So just bear with me. But I want to show you this. Let's bring in our zones here. Okay, so let's bring in some Bollingers. Okay, and take a look where the real rate's moving. Real rate's moving into zone 3. Okay, now that would be very, it would be very odd for it to move into zone 3 if we're not getting into a Fed pivot scenario. Okay, another thing is take a look at the Bollinger starting to squeeze out here. So, and now the last time we were in zone 3 in any meaningful was right back into the COVID crisis. We kind of maybe hit here, but it's a blue candle. We didn't actually close up in zone 3. So we're getting to a situation where we're getting very close to closing up in zone 3. Real rates are moving down. To me, that suggests recession ahead. Okay, you lower rates, and these are longer term rates. You lower the rates to alleviate recessionary pressures. Okay. Again, this is a case, in my opinion, bad news is actually good news for markets, which is odd. But why would that be the case? Because the markets are forward looking. Last year, it was already starting to price in the recession. Now it's starting to price in the recovery. Very odd. Okay, there's about a 6 to 9 month lag there. Okay, one more chart, and then we're going to go through to our instruments. Take a look at this one, guys. Fed funds rate. I want to get rid of the Bollingers. Okay. I want to put in the 2-year yield, Fed funds versus 2-year yield. Okay. The 2-year yield. So the short end of the curve is where the Fed's monetary policy is reflected. I'm just going to change this to a line chart. There we go. And I don't like how this is represented. Just bear with me a moment. I want to do it again. I want it on a new price scale. There we go. That's what I want. Okay, bear with me a moment. Let's go back to the lines. All right, so you can see when the 2-year crosses below, cross below, okay, cross below, cross below, cross below. That's really when the Fed funds rate is topping out, isn't it? Cross below. See that? We're just about across below here. Okay, so you can see that even the relationship between the Fed funds and the 2-year suggesting terminal rate is around the corner. Okay, so what we've seen here, I think we've built up a fairly solid sort of case, a base case scenario where there seems to be suggestions of a pivot. A base case scenario doesn't mean that's what's going to happen. Okay, usually when you do a model, you'll put base case, best case, worst case. So there'll be variance between your base case. So we'll just tag on the line subject to correction. All right, let's go ahead and do some analysis of some charts now. Okay, so just taking a look at US dollar. US dollar is in zone 3. Okay, there's some blue here. Look at the momentum. The momentum is strongly down. Okay, so we're in zone 3 with some blue. Is there a matter of a rally in a downtrend? Let's go down to the hourly, and we've got trigger 1. Okay, it would be worth taking a look at trigger 2, and if we get trigger 1, trigger 2, okay, we would have to get down to the lower quintile and then get the next leg down. Let's go through to euro. So euro should be mirror of this, right? Let's go through to euro. Okay, let's go. Euro is let me get rid of all of this. This was for a trade we did many weeks ago. Okay, we're in zone 1. Take a look, the momentum's looking good. And okay, we've got the triggers. This looks very interesting. Will it work out into a trade? I don't know. It all depends if the momentum's there. So you must have stop losses, must have risk management if this is something that appeals to you. I just want to just it bears repeating. Please don't take this as advice. Okay, it looks to me as if there is going to be upwards movement there. I don't know if it is. It really depends on the underlying momentum as measured by our stochastic. All right, let's take a look at DAX. And then we'll take a look at oil. Okay, DAX crossing up. Let's get rid of all these lines here. I think they're confusing. Sorry, I pressed the wrong button. Let's get rid of all of these. Okay. So what we would need to see is some support at S1. In order for support at S1, there'd have to be a crossover. And there needs to be some sort of movement from the lower quintile back up. So we've got cross 1, we don't have cross 2. It's worthwhile just seeing if we have those crosses. And then we want to see if we get a movement into the upper quintile. So again, this is looking quite interesting. Now, I'm going to throw a little bit of a spanner in the work just to end off. Let's go here. Watch this one. So I looked at this yesterday. We can't ignore it, and it is the VIX. Okay, we can't ignore the VIX. So let's bring that in. The VIX is what's called the fear index. Okay, what it effectively is, it's a measure of options on the S&P 500, and it is effectively a measurement of put versus call options. Put options, if they increase, you'll see the VIX move up. Call options, you'll see the VIX move down. What we want to do here is we're going to add in a RSI. What we're going to do with this RSI is we are going to put in a Bollinger. Just want to make sure the settings are correct. They are correct. Let's throw in a Bollinger Band. So the Bollingers make for adaptive, overbought, oversold. So we can see when the sorry, I'm choosing the wrong thing here. There we go. Let's just change. What's the settings? Yeah, the settings here would be 50 and 1.5. Okay, get rid of the basis here. Okay, and let's throw in the S&P 500. And we make the S&P logarithmic. Okay, now we've got something to work with. So take a look at this. The VIX has now gone oversold. Okay, it was oversold here, and it was oversold here. And then what happens is once the oversold condition normalizes, you have a pullback. Okay, so you had quite a severe pullback from the August signal, quite a sort of moderate pullback in the November signal. What effectively happens is you've got to wait for the nadir, the bottom, the nadir of the signal, and that's kind of when we're going to get a turn here. But so a pullback on the S&P 500 now wouldn't be surprising given the complacency by the bulls. The bulls are very complacent here. But I think that what we would need to keep an eye on is the trend. As long as we get higher troughs, higher peaks. Okay, so just keep an eye on that. So any pullback at the moment, to me, would be a measure of fear based on recession, but it would also be a potential opportunity given the potential Fed pivot. So we just want to be very cognizant of the fact that there is a certain complacency in the market. That complacency will have to correct at some stage. This is a weekly chart, so it can take a few weeks before it works itself through. but it's worth just putting the warning out there. So yes, let's just close everything with a summary of exactly what we are talking about here. We're talking about, number one, the economic data is very weak. If we're not in a recession, we're heading towards a recession. The labor market, okay, is a stealth, giving us stealth signals of weakness. The fact of the matter is, the Fed hiking in that type of environment it's not a good idea. It needs to actually look at some stage to support a recession. That would potentially be good news in bad news, which is a bit odd, but that's the way I see it. It's base case subject to correction. However, there is a certain risk in the market of complacency. So again, there is a complexity in Q1 that we're going to have to deal with. Any sort of pullback we'll deal with to see if there is opportunity. Just bear in mind here, one warning signal is that this could be a lower peak. This could be a lower peak here, but we'll have more to say on that as the price action develops. All right, having said all of that, I think we are done for this morning. Any questions? Please go ahead and type those through. Please. I think I wanted to look at oil as well, just before we sign off. Let's just take a look at oil. And here, oil's tanking after the industrial production came out. Okay, so that industrial production, which is showing decline in industrial production, well, that implies a decline in demand for oil. Bang, there's the decline in oil. All right. I'm not sure what it is. So Anna's asking, so I'm not sure if I am showing ignorance here or not. She's asking what I think of Michael Brewery's prediction. I'm not sure what he's predicted. What is his prediction, Anna? Let me see. That inflation will spike again in 2023. I don't see how. I don't see how. I have heard of this. I have heard that there is going to be a spark in inflation. I don't see how. There's two ways for inflation to spark. It's either going to be on the demand side or it's going to be on the cost side. So if he's made that prediction, is he predicting it on the cost side, which would mean another oil spark? Or is he predicting it on the demand side, where it's effectively China that's reopening and putting the demand for oil? That might be a possibility, by the way. It's something that we have to keep an eye on. I would suspect he's probably looking at it on the demand side. It makes more sense to me. My feeling here is that the demand side is inherently weak. I guess China does present an X factor, so I think there might be something in that prediction. Anna, let's keep an eye on it. Thank you for bringing it to my attention. Any other questions there? That's my stochastic configuration, 1555. 1555. Alrighty, let's wrap up here, guys. Thank you very much, and have a good day, good evening. We'll chat again tomorrow.